Welcome to the Global Investor Podcast, a show that focuses on helping foreign investors enter the lucrative U.S. real estate market. Host Charles Carillo combines decades of real estate investing experience with a professional background in international banking to interview experts in all areas of U.S. real estate investing. Now, here's your host, Charles Carillo.
Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Spencer Gray. Spencer has been involved in over $1 billion in transactions since buying his first rental property in 2006. His company, Gray Capital, focuses on value-add multifamily, core and core plus multifamily, and opportunistic commercial real estate. So thank you so much for being on the show.
Absolutely, Charles. Been looking forward to coming on.
So give us a little bit on your background prior to starting, both personally and professionally, prior to starting to invest in real estate.
Yeah. So, I've been investing in real estate, like you said, since 2006. And that was, just prior to me graduating high school. So, I've been doing it for quite a while. I kind of stumbled into doing that, though. Wasn't really setting out to be a real estate investor. I got kind of dragged in from a friend who was doing it, who was really his father was doing it, and he was helping his dad and needed a partner. And what that really did is it planted that first seed of, really opening up to the idea of real estate investing as an option and as a possibility, because everyone knows that there are real estate investors out there, but until you kind of get a little bit of a taste of it and see that it's real, it can seem like maybe it's challenging or maybe it's too good to be true, because maybe you've heard a horror story of you heard a get rich quick scheme, but to me it became a real thing. And even though that project wasn't really very successful, we didn't make any money on it because this was just prior to the Great Recession. Credit started getting tightening up when we were trying to actually sell the property, and we kind of were relying on those kind of those ninja loans, those no income verified loans that people could get back in the mid 2000s as our end buyer. So we had to turn it into a rental. But so our first deal kind of had problems and things that we had to work out. I had learned things about partnerships. My partner, my friend, he's a great guy, but he really wasn't present in the deal. And I ended up kind of running the whole thing. So I learned a few lessons. But then kind of fast forward, because I didn't go into full-time real estate investing at that point. I went off to college. I was really passionate about two things, and that was being an entrepreneur, and I was passionate about music and music production. And so I went to music school at Indiana University, wanting to get out, kind of work in the music business, whether that was being a recording engineer, working for a music distributor, and so I did that. Graduated, moved out to New York City. Working in recording studios, working for media distribution companies, a freelancer, working for audible.com, editing audiobooks, all kinds of stuff, and trying to kind of build out my own business doing that. And I loved music and I loved doing it, but I was getting burned out because I wasn't really doing what I had really set out to do. But more importantly, the entrepreneurial side of me, because as I'm in the real world, trying to make money, I couldn't put a business plan together that made sense to me to actually kind of chart a course. And so I started kind of opening up my mind and saying, what else is out there? I want to build a business. I don't want to just do something if there's no real traction there. And so that led me to continue to flip houses. And then also I started a business with a friend and my now wife, where we started a small hop farm in Indiana to sell locally grown hops to craft brewers. Very quickly got into a business of brokering hops from really actual commercial farmers out in Washington and Oregon to distribute to craft brewers across the country. That ended up being quite successful. We started exporting hops to all 50 states internationally, ended up selling that business in about 2015. And I was at a point where, I wasn't done. I wanted I was looking for that next opportunity, that next business, and buy and hold multifamily kept coming up. And so I took a deep dive, educating myself as much as possible, reading books, getting on forums, networking. And that led me to have the opportunity to partner with someone who was a couple steps ahead of where I was already syndicating projects, even though I didn't really know what a syndication was at the time. I was able to basically say, I want to participate with you, because I had figured out that I couldn't do it on my own. But I said, I wanted to kind of be in the trenches and learn from you. And so I ended up co-sponsoring projects with him. We eventually went on to co-sponsor about 15 different syndications with that operator. We still co-sponsor and co-GP projects with that group. Then about 2018 or so, we said, okay, we've got a lot of experience now. We know what we're doing, but we want to do things a little bit different than our partner is doing. And so we started doing our own projects, becoming the lead sponsor and syndicating our own deals. And doing the rest is his history. We've kind of built out our own firm, our own team, and we're focusing on our own acquisitions, primarily in the Midwestern United States. And like you said, value add and core plus are our two main focuses.
Nice. I want to step back just a couple steps. There is tell us about your first multifamily real estate investment.
Yeah.
What you're doing with it, how'd it go, what happened, how'd you source it?
Yep. So the first multifamily investment was a co-sponsorship with this partner in Indianapolis. It was, I believe, a 220 unit C-class value add property. In Indianapolis, kind of in the Speedway neighborhood. So it's near the kind of the racetrack where they do the Indy 500 every year. And it needed a lot of work. It had been neglected really for the past several decades. The last owner really didn't put the resources into it that it needed. And so it needed, every single unit needed to be updated, incredible amount of exterior deferred maintenance. But, we got it at a pretty good basis. I think we bought it at that time for like 43 or 45,000, per door. So, relatively good basis. We put a 223 HUD 223F loan on it, which is able to, finance, quite a bit of the construction as well. And so it was a challenging project though. So it was, my first multifamily project. It was the biggest project that my partner had done at the time, certainly the largest rehab. And it was a property that, every time you go in to fix one thing, three other things would break. And so it just, there was so much work that needed to be done on the interiors, the pool cracked, so many things kept going wrong that in a sense were outside of our control. But that gave us a really kind of good lesson. One, really, you have to really watch the property that you're going to be going into. If it does have, a lot of visible deferred maintenance, there's going to be more that's not visible once you get into that project. And so, whatever capital you think you need for renovations, you need to have a very, very hefty contingency on top of that. And so really to overcapitalize really any project, because you never know what's going to happen. It's a way to kind of mitigate risk and de-risk. But especially if you're doing a major value add for an older property, this was built in 1968, I believe, some things are going to be breaking and you're not going to know. I mean, when you're doing due diligence on a property, you may have, 30 days, but really you're going to be only in there for a couple days doing an inspection. Even if you walk every unit, so you usually have 1 to 2 days to walk every single unit. And you're usually, checking out, what's in each unit, what are the appliances, the condition. But, to be able to formulate that full business plan to exactly know how many dollars you're going to need, it can be, there's a lot of, educated guessing that goes on in building out that budget. And so just to overcapitalize, to say, okay, we believe we need, call it $1 million. Well, let's bring on, another $250,000, maybe even $500,000, depending on kind of the scope of the project, in just extra contingency, to a point where, you don't want to reduce returns because, the more equity you bring on, those returns are going to go down. But we got to follow the first rule of, not losing money and preserving principal. And so if you can't execute the business plan in a responsible way, then you probably need to readdress your business plan. So the lesson really was to overcapitalize, prepare, hope for the best, plan for the worst. The result of that, though, was, we were able to sell the deal for, over, I think it was a 25% IRR, ended up being a 4-year hold. So, ended up being a great project, but there were many, many bumps in the road to kind of get to that point.
Yeah. It sounds like that. How hard was it to get, because we never talk about HUD loans on this.
I know, no one does.
Tell us about that. I mean, that's just kind of not many people would go down that route, and you can kind of explain probably why in your experiences.
Yeah. So it's a lot of headache to get one of these HUD 223F loans. Now I think it's worth it for the right project. It's not right for every project. But if you are interested in a long-term hold, so, really thinking at least 7 years, really 7 to 10 year time frame, a HUD 223F loan is a great program because it's a non-recourse loan. It can typically go up to 85% of the cost of the project. It 35-year term, 35-year amortization, and so that provides an incredible great option because even compared to an interest-only loan, which these HUD is not interest-only, but your debt service can often be kind of similar compared to like an agency interest-only product based on the amount of amortization, getting that 35-year term. So being able to lock in, also the interest rates are incredibly lower than agency typically, for fixed rate. Typically the rates are lower. A fixed rate HUD loan is often lower than a variable rate agency product. So we're getting ready to lock in another HUD loan now. We're being quoted in kind of the 2.2% range. Wow. So now here's the other side. It's an incredibly long process. You can't close on a HUD loan. You have to close on a bridge loan with a lender who understands the HUD process that can properly size the HUD takeout. So you have to go. So there's another loan that you have to put in place when you close. While you're starting the process to go on to HUD, the HUD process can take, we were told, they say 4 to 6 months, but it can take all the way up to a year. COVID has completely backlogged all of the HUD offices. So it takes, we've been working on one now for 8 months, and we're hopefully going to be closing here in the next, month or two. So it's a long process. It's a lot of documentation. It's a lot of paperwork. And then there's also a few strings attached. So for one, there's a surplus cash flow calculation so if you're going to issue a distribution, you have to meet certain reserve requirements before you can distribute from that project. Compared to Fannie or Freddie, it's your bank account, you can do what you want. Also, there's an annual audit that you have to do to comply with HUD. And then, then there's inspections, REACT inspections, which you have similar inspections for agency products as well. And so it's a flip side though. As an investor, I kind of like some of those covenants of, I don't mind the project being audited by HUD, make sure the operator is doing the right thing. I would like, maybe to distribute, more than the surplus cash flow would allow, but at the same time, you're following that first rule and you're preserving principal. It's ensuring that you've got enough cash in the deal to, cover debt service, cover repairs. So make sure the deal is very healthy, which makes you overcapitalize. But if the deal can support, those things, it can be incredibly attractive for, a long-term hold. So when we're looking at more of our core plus acquisitions or even a core acquisition, that's where often it makes sense looking at HUD, because knowing that this is going to be, like a longer term cash flow play, it can be, a really attractive route to go.
When there's 2 distributions that are allowed per year with that?
Correct. Okay. Yep. Semi-annual distributions. That's one of the other covenants. So you can't do monthly distributions, can't even do quarterly. It's, 2 distributions a year, which most investors, a lot of investors prefer monthly or quarterly distributions. Once you explain the process, we haven't had much kind of pushback from our investors. They kind of understand, the benefits of the HUD loan, and so they're okay with it.
Yeah, getting that debt just over 2%. When you sold that property, did the buyer assume that loan?
They did not assume that loan. So we've done a couple HUD assumptions on the buy side, but they bought it, and you can pay a couple extra basis points to have a reduced prepayment penalty. Because that's the other piece. There's a rather steep step down prepayment penalty, and the price had appreciated to a point, and we had paid those extra bips for a reduced prepayment penalty, where it was still a very profitable sale, even having to pay that prepayment.
Nice. Okay. Awesome. That's quite the deal for your first deal out there. And so what is your firm right now targeting? You guys are targeting a ton of different asset classes within real estate when I was preparing for this. What is your current acquisition criteria and strategy?
Yeah. We've invested in quite a few different asset classes, whether it's been a, lead sponsor, co-sponsor, or we've just been a more of a limited partner on some projects. What Gray Capital is focused on is really 100% is multifamily acquisitions right now. So we have two investment silos. One is a value add silo where we're typically looking at newer properties. When I say newer, I'm talking like mid 80s to kind of early 2000s for that needs a value add, need a lift or a reposition. Typically not extremely heavy value adds. We really prefer stabilized assets that we can really improve because we're focused on cash flow. And so we want to be able to have some degree of cash flow at acquisition. But our other investment silo is our core and core plus silo. And so these are much newer properties that don't need significant renovations. They may need minor, very light value add business plans, but oftentimes it's more of operational efficiencies. And so these properties could be built kind of mid 2000s all the way up to essentially brand new. And we feel when investors are looking at not just investing in apartments, we want people to take an approach of looking at it as building a portfolio. We don't want you to invest in just one deal, and really not just with one operator in one geographic region. We need to build a diversified portfolio, and we feel like different strategies of more workforce housing, which is kind of usually most value add deals follow in that category, as well as more core and core plus, which are typically kind of renters by choice rather than workforce housing, which is renters by necessity. It allows you to diversify to do different income demographics, because different income demographics kind of behave differently in different stages of the economy. And so we want to build as a robust portfolio as possible, and having exposure to those different income brackets, we feel really diversifies one's portfolio and allows to mitigate risk.
So I think everybody understands the value add model. We find a property, it's rents for identical unit rents for $1,200 next door. This one rents for $1,000. We do it, but it's not updated. We update it. We raise the rent. Talk about finding efficiencies. Give me some examples of efficiencies you would find in a core plus. So we're talking, B plus, properties that are 15 years old, 20 years old. What kind of inefficiencies are you finding that are you're kind of like licking your chops when you're looking through underwriting and you see what's going on?
So I've got a good one. And so this is a deal that we closed on just last year in December of 2020, 2018 construction. Beautiful new development, Class A luxury asset. If you looked at the pictures, you would say there's no way this deal cash flows. The returns on this thing are going to be so thin, because how many times you've probably seen a package come up, new deal, and you're like, yeah, it looks great, but it's not going to cash flow enough for me. Most other buyers thought the same thing. When we took a look at it, we were able to find so much meat on the bone because it had been built by a merchant developer who still owned it. Their business plan is to get it leased up as quickly as possible and to flip it out. Wow. They're not trying to hold on to it. So the amount of concessions that they were offering, the marketing budget, their administrative budget, the payroll that they were paying was so over market. We were able to cut $300,000 in just concessions in the first 2 months. Annualized in the first 2 months of ownership. We're able to cut over $75,000 in marketing. We were able to cut almost $100,000 in admin budget. We've been able to dial the payroll in because they had some specialists they had flown in that had payroll that was twice the rate of normal manager. So we were able to bring in so many efficiencies. Not only that, the rents were under market because they were trying to get it leased up, so they weren't pushing rents. We're increasing rents $100 on some units. We've already increased rents 3%, just total, not annualized, 3% on the entire property. Annualized, it's a 12%, rent increase on the asset. Again, this is 2018 construction.
Wow.
We pro forma being able to produce 8% cash on cash from the gate. We're getting ready to close on a HUD loan, 35-year term, 35-year amortization. The rate's going to be, 2.3, 2.4% that we're locking in for 35 years, which is lower than what we underwrote. It's going to create an additional $100,000 of cash flow because of the difference in the interest rate. So now we're going to be able to be producing double-digit cash-on-cash returns from an A-class, brand new luxury asset, which is higher returns than the 70s vintage, 80s and 90s vintage value add deals that we've been underwriting all year that produce, low teen IRRs and low cash on cash, a huge renovation risk, or huge, because there's a major renovation, there's a significant amount of risk. You're going up the risk spectrum with the idea you're going to be compensated for a nice return. We scratch our heads when we see a major value add project that, pencils out a 13%, 14% IRR. You're taking significant amount of risk, but you're not being compensated for it. And so that's an example, most recent example. And not every deal is like that. Not every Class A deal is like that. A lot of them don't cash flow, but I think many assume that they won't, so they don't try. And also, I think there's a little bit of an echo chamber. Everyone's talking about value add deals. We love value add deals too when they make sense, but when you pigeonhole yourself and saying this is the only strategy that I'm going to look at, it also is, the art of the possible, because that deal is a $60 million deal. Most people are looking at smaller project, which are understandable because they're looking at, what can I pay for? What can my investor base produce right now? I'll tell you, at that time, we didn't have all the money, figured out. It was a matter of, putting the team together, having the networks in place, and, being confident in, the business plan. And so when my director of acquisitions brought the deal for me, I'm like, I don't know if we can raise $12 million. I think we can. We're going to try. And it was a challenge, but we said, let's give it a shot. And, we had it raised in about 3 weeks. So it was such an attractive project.
Were the tenants subpar that were in there because the guy was just going crazy leasing up?
No, not that bad. I mean, it's good. Very professional firm. Actually, the average income at the property was $120,000. So, very strong, nice resident base. There were a handful of residents that were not the best. One actually sued the previous manager while we were in the process of closing, a fair housing complaint, completely BS. Got thrown out. She was more or less an ambulance chaser. We kind of did some research. So there were maybe 2, but you find that on any deal, and you're going to find high quality, low quality residents kind of even at A-class properties. Unfortunately.
It's like when you're looking in a town to buy, there's one part of town where you can't afford, and there's one town where you don't want to move to. So, exactly. I mean, it doesn't matter what town it is, where it is, anywhere. So you guys got $1 billion worth of assets under management. What are some of the best ways you have found to find, nurture, and keep investors? Obviously, you just raised $12 million for that deal.
Yeah, well, and just to qualify, so we don't have $1 billion of assets under management. It's closer to $500 million, but we've done about $1 billion, a little over $1 billion worth of deals. Not only bringing on investors, but maintaining them is huge. I mean, obviously, the first step is if you're producing results. I mean, that's going to be the most effective way to keep investors if you're doing deals that work. But then, it's doing what you say you're going to do. So if you're going to say you're going to communicate at whatever rate, monthly, quarterly, you need to be communicating at that rate. Staying in touch while not being annoying. Don't be sending out emails of just saying, hey, literally we're here, and not really useful information, you're not adding value. But communicating in a way that you are adding value, and sending information that's going to be interesting to those investors of, hey, here's an article that just came out, it's about our deal. I just want to make sure that you saw it. Or, hey, do you see this is going on in the market? Because investors, they're passionate about this just like we are, and they want to know what's going on, and they want to stay up to date. But you don't want to pester them too much. So it's adding value, staying in touch, communicating. But at the end of the day, kind of results matter more than anything.
Interesting. Yeah, for sure. So as you guys grow your business, what are some of the challenges you have faced or you face currently?
The challenge we're facing right now is, the market's moving so fast, and trying to stay on top of it and finding the balance between being reasonable in our assumptions and, being, conservative in a sense that, again, we want to preserve principal and not lose money, but at the same time, inflation's at over 5%, household formations at a multi-decade high, rents are growing in our markets of anywhere from between 7 and 14%, and so you can't use the same assumptions you were using in 2019 for real estate in 2021, but at the same time you can easily overshoot that because you can't underwrite 5 to 12% rent growth every single year. Maybe you're going to get it this year, and I think we've already gotten it. It may even be more by the end of the year. But so you have to find that balance of find the balance between, being aggressive enough, but at the same time, sticking to fundamentals.
Right. Okay. What are common mistakes you see other real estate investors make?
So one of the most common mistakes I see investors make is in that transition from taking theory into actual practice of, they've been, learning about real estate investing, multifamily. They're trying to figure out how to do their first deal. But to get that first deal is such a leap, and it's a leap of faith. But once you do that first deal, the rest becomes, much easier. You really get some momentum very quickly. You hear a lot of people like Michael Blank will talk about the law of the first deal. You do one deal and you're going to do two deals right after that. And that is often the case. I've seen that many, many times happen to myself multiple times, whether it's co-sponsored deal, then doing our own deal. Is one deal, then bam, bam, bam. But it's hard to kind of put together that business plan without really having some experience. And so in people, I find new investors, they don't reach out and to leverage others' experience, and whether that's bring someone on, kind of as a coach or a consultant, or that could be, partnering as a co-sponsor, or that could just be investing as a limited partner and just getting some of that real world experience, seeing how a deal is actually put together, and really with someone with some experience to say, okay, yeah, that's what you're going to read in the books, or that's what you heard in a podcast. Well, that book was written 5 years ago. That's not where the market is right now. This is just the reality of the market itself. And if you want to participate, this is what you need to do. Because if you believe in kind of the thesis around housing and multifamily investing, and it's very solid. I mean, especially right now, I mean, there's a complete imbalance of supply and demand for housing, especially somewhat affordable housing. You need to participate in that industry, in this investment kind of thesis, in this ecosystem. So how do you get in? You have to get started, and it may take a leap of faith, because your book may say you need to buy a property at an 8% cap rate. Well, you're not buying a property at an 8% cap rate, and if you do, that level of return, that cap rate, that means that's indicative of the level of risk in the project. And so even going for a lower cap rate project that is going to be lower risk, but the deal actually might work, which that is kind of the opposite of what I hear from a lot of first-time investors saying. They're like, well, I'm looking for a 7 cap, or I'm looking for an 8 cap, which is really the wrong way to look at it, especially in today's market where cap rates, they're really not very useful today. Now, they may be more useful in a couple of years ago, but people are buying deals at 3 caps and 4 caps. And it's not because they're going to let it sit there. It's because they've got a business plan to kind of get there to a more stabilized kind of operating budget. So
yeah, that's definitely a new thing with new investors. They're always asking about cap rates, and they have a cash on cash in mind, and it's usually very high, and they have a cap rate in mind, which is usually very high as well.
Yeah.
So as we're finishing up here, what do you think are the main factors that have contributed to your success?
Well, I think partnership, being open to partnerships, open to collaboration. If I hadn't partnered with that one partner on that first deal, who knows what the future would have held. And then being persistent, because I had to keep being persistent in order just to have that meeting and to be networking to get that introduction to make that happen. And so if you're showing up, like they say, most people just don't even show up. If you're just showing up, if you're there, if you're networking, if you're learning, if you're making offers, it can be incremental progress, but if you keep showing up, things are going to happen. And all of a sudden you're going to find yourself partnering on a big deal, much larger than you ever thought that you could take down. And it's okay if you don't know everything. You just need to surround yourself with folks that do.
Yeah, that's what happened on my first deal with our group. It was just, I had no idea. I was just networking with someone, and then they're like, hey, we have this deal. And you're like, oh, okay.
Yeah.
Well, let's do it. So how can our listeners learn more about you and your business, Spencer?
Yeah, so our website's greatcapitalllc.com. We have a great newsletter I'm really proud of that the team puts together. It basically aggregates every new research report and article on the multifamily industry and real estate and the economy. So hop onto our website, greatcapitalllc.com. You can check that out. We built a new service. It's called the Gray Report, grayreport.com. It is an extension of the newsletter in a sense, where it's an aggregator We have like a ton of RSS feeds, virtual assistants kind of scraping the web, finding all of this research and data revolving the multifamily industry in real estate. So it's greatreport.com. Then, you can find me on LinkedIn, shoot me an email, Spencer@greatcapitalllc.com. But yeah, so you can just Google us, we'll pop up.
Okay. Well, that sounds great. Well, thank you so much for coming on today. I will put links into the show notes and looking forward to connecting with you in the near future.
Absolutely, Charles. Really appreciate you having me on.
Talk to you soon.
Talk to you soon. Thanks.
Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Thank you for listening to the Global Investor Podcast. If you like the show, be sure to subscribe on iTunes or Google Play to get new weekly episodes. For more resources and to receive our newsletter, please visit globalinvestorpodcast.com. And don't forget to join us next week for another episode.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.